and welcome to Greco Talks Money. I am Marissa Greco, and here my brother James Greco is here. We're your financial professionals, and we're here to talk about bear markets explained. So, James, why don't you kick us off and tell us what is a bear market?
Yeah, so what is a bear market? A bear market is defined as a decline in the stock market by 20%. Conversely, a bull market is defined as going up more than 20%. You might be asking yourself, well, what actually happens during a bear market? On average, stocks decline by 35%. That's the average bear market. Contrastly, on a bull market, stocks gain 114% on average. So you can see you don't want to sell during a bear market and you want to hold until we get to the bull market because that's where you're going to capture all of your return.
Yes, and if you have been paying attention to the news or the media at all, you know that last year was not a great year in the stock market. We ended 19.9 down in the S&P 500. If you were more diversified in international and emerging markets, then you may have been down even a little bit more. And so this could have been considered a bear market, right? And so what did we notice happened in this bear market? We started to see inflation increase, and we've seen in general that housing prices have come down a bit and the stock market prices have also come down as well.
Yeah, and technically we're not in a recession yet because a recession is defined as 2 quarters where you have decreasing GDP. So we're not in a recession yet. However, we'll see how this proceeds in the next few months.
And that's one of the biggest questions we've been getting is, are we in a recession? Are we going to enter a recession? We will know more when it comes into the spring and the summer and we see what the Fed does. If they hike up again, then most likely we are going to be trending towards a recession. But this is the thing. Throughout your lifetime, you're always going to be going into a recession, in a recession, or coming out of a recession.
Yeah, to give you an analogy, if you're a professional athlete, right, you need to have rest days in order to perform at your best on game days. Well, that's what the market does. It takes rest days, and sometimes it goes down. However, in the long term, it usually trends upwards.
And yes, what I think is really interesting is that 42% of the time, the S&P 500 strongest days in the market were in the 20 days occurred during a bear market. So basically what this says is that you could have a really good day in a not so good time period. And why is that really important? Well, this is really key because most investors, what do? They see that their accounts go down, they see their values go down in their investment accounts, and they want to sell. Emotionally, they want to sell, and some people do actually sell and take losses. However, if you miss just a few of the best days in the market, you could be really cutting your overall return down. So this is why you want to stay invested even during those bad periods of time because most likely there is a good day coming.
That's a great point, Marissa. Going back to our earlier point, I just wanted to add one thing. A bear market doesn't necessarily mean that a recession is coming. There's been 27 bear markets since 1929, but only 15 recessions during that time period. So you can see markets often go hand in hand with a slowing economy, but a declining economy doesn't necessarily mean we're going to be in a recession. But as Marissa alluded to before, in this case, we don't know if we're going to be in a recession yet. It all depends what happens in the next few months with interest rates.
Yeah, and one of the biggest questions we get is, okay, well, if a recession does happen, what do I do, right? Do I change my investments? Do I go all the cash? Do I go on all bonds? So let's take a little time, James, to just discuss what we're personally doing as we potentially are entering a recession. So one thing I like to say when you're entering a recession is to really tighten up your expenses, right? With the inflation being as high as it is, you've noticed your gas prices have gone up, your food bill has gone up, and so you have potentially less money than you did before to work with. So we need to tighten up our budget and make sure that we understand where our money is going and try to reduce those expenses as much as possible.
To that point, you want to keep your emergency fund, right? Just in case anything happens, you lose your job, etc. You don't want to have to go into your portfolio to sell any of your investments to live your lifestyle that you need. So we want to make sure we have our emergency fund in place anywhere from 3 to 6 months of your monthly expenses in cash or cash like investments.
Yeah, and speaking of cash, there are great right now cash alternatives where you can be earning a higher rate of return than potentially your brick and mortar bank, right? So there's high yield savings accounts, CDs. Some people are even looking into index annuities and certain things where your principal is somewhat protected, right? If you're staying under FDIC limits and all of that, and you're earning more though than you would at your brick and mortar bank. So take a look at your cash vehicles and make sure you're maximizing the opportunity there right now because cash is paying more since inflation rates have gone up.
The next thing you want to look at is if you're working, you have your emergency fund in place, we have extra cash flow. Well, we don't want it just sitting in the bank, right? We want to invest some of those proceeds if you have your emergency fund in place. And the reason why is the markets are down right now. So the S&P 500 is down around 10% approximately. So you're buying into a discounted market. So if we look out 3 to 5 years, we're hoping that the markets will be much higher. You bought in at a good price.
Yeah, that's an awesome point, James. So these are the things we would be looking at and reviewing if we were looking at our own portfolio. Obviously, the biggest thing is to think of the longer term picture. So my favorite saying is when in doubt, zoom out, right? Because if you look at the overall picture of the market, you will notice the overall trend has been up, right? But there's definitely been time periods in history where we go down, and it's very normal that we do. So keep patient, keep invested, and in the end, we will reap the long term gains that we have looked at in the past. So staying invested is usually the most prudent thing to do when we are in bear markets or entering into a recession.
Exactly. You want to weather the storm that's going on right now. Hopefully, sooner rather than later, we come out of this bear market. You also want to make a few tweaks and rebalance annually as you see fit and see where the macro environment is going. However, the most important thing, as Marissa alluded to, is you got to stay invested during this time period. You definitely do not want to sell into a down market.
We really want to thank you for listening to Bear Markets Explained on Greco Talks Money. If you have any questions when it comes to bear markets or recessions and how to be looking at your potential portfolio or retirement planning, then make sure to reach out to us with any questions. And again, thanks for joining. Like and subscribe our channel and follow us for more.